Hello everyone, today is the 10th of June 2026, and as I record this update for you, the strikes and counter-strikes between the US and Iran are still ongoing. But let's be clear, the ceasefire is still in place because these are just self-defensive love taps, right? What's incredibly noticeable right now is that the oil future prices are barely reacting to this escalation in the Middle East. On the contrary, they dumped heavily after the latest barrage of fake news headlines prompted by President Trump. Remember how on Monday he claimed he would be able to sign a peace deal with Iran by the end of this week? He made this very same claim 38 times already, and somehow it keeps working. Needless to say, something is very wrong in the oil market at the moment. In the first part of today's update, I will provide even more evidence that shows how the world crude oil market is coming very close to a watershed moment. Because the moment when the reality of the worsening oil crisis cannot be hidden anymore is approaching fast. I will also explain why oil prices are still not reacting to any of the recent developments. In the second part, I will conclude with my comment on what's happening against the stock market since Friday. This follows up on what I discussed with you during the weekend. I will end with a chart that I believe is a preview of the black swan brewing within the financial system. A black swan that could strike when people least expect it. Before we begin, don't forget to like the video, subscribe to the channel, and turn on the notifications if you don't want to miss any of my future updates. Let me start with the first part of today's update. I want to borrow a quote from Luke Gromen that is very spot on. He said that all the oil traders who are not government insiders are currently sitting on the sidelines. They are tired of being front-run by insiders. To be clear, that is not healthy for a market because it effectively acts as price controls. What Luke currently implies explains why oil prices have only reacted to positive fake headlines and not negative real news. The oil traders who deal with commercial inventories and stockpiles for industrial and energy consumptions are now relying on drawing down commercial inventories. They do this to avoid paying current higher prices in the open market because there is still strong belief that the situation in the Strait of Hormuz can quickly normalize. That still gives a great deal of leverage to the narrative the US government has been pushing. CNN calculated that Trump played 38 times. It was just days away from signing a peace deal with Iran and fully reopening the Strait of Hormuz. 38 times it didn't happen. Still, the risk that everything could return to normal quickly remains strong among operators, refiners, airlines, shipping companies, and so on. They feel it's not wise to bid anything in the market right now, unless there is certainty that a return to normal won't happen. There is a problem though. Strategic petroleum reserves and commercial inventories are dwindling. For the fourth week in a row, we expect to see another monster drawdown reported by the US EIA at 10:30 a.m. Eastern Time today. Let me remind you why we keep seeing these monster drawdowns. The US is exporting its inventories to allied countries like those in Europe and Japan to buffer the oil supply shock. This is an effort to maintain the price cap as long as possible. As I record this video, we have lost almost 1.3 billion barrels of oil supply since the beginning of the war. Let me be clear. This supply has not been replaced by the dump of strategic petroleum reserves, nor the significant drawdown of commercial inventories. This action is only postponing the moment when the oil shortage will hit. These inventory drawdowns cannot continue forever. This chart I'm presenting now shows why oil executives keep warning about a sudden crisis that can unfold at any moment. When Cushing Oklahoma inventories fall below the operational bottom of 20 million barrels and are expected to remain below that threshold, the oil market tightens up. These are the so-called tank bottoms. This scenario has happened only once in the past 30 years, between 2007 and 2008, when WTI crude oil prices hit an all-time high of $148, as highlighted. There have been other cases when Cushing inventories briefly dipped below the 20 million barrel mark, which is the structural minimum. Below that level, problems start to surface in the supply chain. But those blips were temporary. They were quickly overcome either by the big shale revolution supply in mid-2010s or by the lockdowns in 2020, or in 2022 by the very large dump of strategic petroleum reserves that stabilized the market even though there was no supply shock from the Russia-Ukraine war. As you can observe, lately we have been hovering around that number, and in the past weeks it started to roll over. The situation between 2007 and 2008 and today is completely different. Today, allow me to say this, is horrible. In 2008, US strategic petroleum reserves were near all-time high. Today, they are at all-time low. Furthermore, US strategic petroleum reserves are expected to hit 280 million barrels, an all-time low, in roughly 7 weeks. Other countries around the world are hitting all-time lows at the same time. US SPR won't be refilled for years based on the latest lease agreements, through which these reserves can be sold to commodity traders. At the same time, commercial inventories are at critical lows. And as if this wasn't enough, demand destruction at current oil prices has been negligible. A crash in oil imports from big buyers like China is not signaling demand destruction. The gap is compensated by draining national SPR and commercial inventories in cooperation to keep oil prices capped. Many analysts and commentators out there are making a big mistake by calling this demand destruction. Lastly, transit in the Strait of Hormuz will take time to be reestablished, even in the very best case assumption that is fully reopened right away today. That is not going to happen because the US and Iran continue to bomb each other and couldn't be further away from signing a peace deal, objectively speaking. Cushing inventories are expected to fall below 20 million barrels within 2 weeks. Then they will keep dropping and potentially remain below that critical level for months, similar to what happened in 2008. Beware, the historical low was 18.9 million barrels, and high chances it will be broken. However, this time it will happen without any buffer of oil reserves to compensate. Similar dynamics will happen all over the world. This will force a bid for crude oil in the spot market until the price is high enough for the market structure to find equilibrium with the available supply. Likely, the price will overshoot as panic bidding for more stock and a squeeze of short positions occurs. Furthermore, the long end of the oil futures curve will be impacted by restocking ahead of winter. That restocking will have to be intense given how critically low commercial inventories and strategic reserves are. Let me be clear, this scenario is inevitable. Whoever says the contrary at this point is spreading very dangerous misinformation. Now that it's clear the oil market is heading towards a brick wall at 120 miles per hour and blindfolded, let me move on to the second part of today's update. As I explained during the weekend, the market reaction on Friday had nothing to do with the US non-farm payroll. The proof is that after a brief dead cat bounce on Monday during US hours, stocks started to roll over into the close. That signals buyer exhaustion. The bounce was mostly due to the relentless amount of bullish narrative pushed out by Trump and his administration to reassure the market and prop everything back up. Then on Tuesday, we saw something big, example of buyer exhaustion. Even though pre-market stock indexes were deeply in the green, they crashed immediately at open and kept crashing. At one point, the Nasdaq was down 3% on the day. Some losses were recovered afterwards, despite Donald Trump posting in the middle of the day that he would have retaliated against Iran for hitting a US military helicopter over the Strait of Hormuz. Clearly, volatility in oil prices or strength in oil prices cannot be blamed for this price action in stocks, considering the weaknesses. This is a clear sign that the two dynamics are related to different causes. As I emphasized again during my last video on the weekend, rest assured they will blame an eventual crash in the stock market on the oil shock. That's the easiest excuse available. Now I want to present a second chart showing something incredible that is still being ignored. It is the relationship between the Japanese yen and oil prices. Let's not forget that Japan is an economy that imports pretty much all of its oil energy supply because it has no domestic resources. Because of higher prices, Japan is paying more to fill the gap. It cannot overcome that by releasing strategic petroleum reserves. Those reserves have been dropping like a stone. As I record this podcast, almost 50% of Japan's strategic petroleum reserves, one of the countries with the most reserves, have already been used since the beginning of the war in the Middle East, clearly in an effort to keep prices capped. but the currency market is refusing to ease up and soothe the situation is a sign that something very wrong is happening underneath, deep down in the market's plumbing system. The last time we observed this was in the summer of 2024. Remember, the government had already intervened several times unsuccessfully at that time. It did the same today, burning $70 billion of monetary reserves this year in a necessary but unsuccessful effort to prop up the currency. When in 2024, Japan came strongly into the market with a massive intervention that almost crushed everything, the Nikkei was down almost 20% that Monday. You must be aware that these types of developments are in the cards. Either the JPY strengthens significantly, or at the current level, the JPY is signaling that oil prices should be already around $115 a barrel to close the gap. And since we know from the first part that an oil shock is coming, that oil shocks might actually weaken the JPY beyond the breaking point, that will start free falling. That will trigger a financial disaster that will reverberate across the globe because of a forced JPY carry trade unwind. Don't forget, there is more than $2 trillion equivalent of leverage used to purchase assets across the globe via the JPY carry trade. And it has not been unwound meaningfully at all in the past years, despite a significant rise in JGB yields and weakening of that currency. This is the black swan lying in plain sight everyone is ignoring. This is why I wouldn't be shocked if we see a massive coordinated central bank intervention starting from the Fed. This is also why those who believe the Fed is going to hike rates to tame the impact of skyrocketing oil prices and control inflation are wrong. I consider that the real mandate of the Fed is not full employment and low inflation. It has been proven over and over again in the past years that the real mandate is to maintain financial stability. And that can only be assured in one simple way: maintain financial conditions loose, print out of control money, continue to finance government deficit spending, and destroy the purchasing power of currencies. Thanks a lot for listening to my update again today, for supporting me on X, Instagram, and for reading my research on JustDario.com. I wish everyone a nice day. Bye.